Welcome to the Real Vision Daily Briefing. It is Wednesday, November 9th, 2022. I am Weston Nakamura, Real Vision's Global Markets Editor, and I am joined today by the great Darius Dale, founder of 42 Macro. How we doing, man?
I'm good, man. How are you, buddy? How are you? It's good to see you.
Well, turmoil in crypto.
It feels like that's turmoil in crypto every time I come on.
Turmoil in crypto as we speak, with headlines breaking right now. We have midterm elections to cover, and we have US CPI on the horizon. And so we're gonna try to figure out what matters for markets writ large. And I don't think that we can do that in a half an hour, but well, let's give it a shot, shall we?
Yeah, absolutely. That's our job, buddy.
Yeah, so right now, as we speak, there are headlines breaking that Binance is currently walking away from the deal with FTX. This is happening while Gary Gensler is also speaking. This is all breaking headlines, and I'm not going to follow them while I'm on IR talking to Darius with other matters going on as well. But that is clearly moving markets to the downside. As a matter of fact, we do have a clip from a crypto daily briefing from earlier today. And so let's just play that because it's really very relevant to what I want to get into first.
And I could tell you what brokerage firms work on is trust. We put together things like capital rules and segregated assets and haircuts for risky things. But all that's to say you have to trust me personally to run this firm. And when that trust is gone, all the financials in the world don't matter. Everybody wants to get away from you because their money is at risk. And what SBF didn't realize is that he wasn't trusted. So at the first sign of trouble, everybody ran from him. And this is Dick Fuld at Lehman Brothers. This is John Corzine at FF Global in 2011. We've seen this movie over and over again. And when they start to run and the outflows start, the bank run starts, it's very, very hard to stop it. There's only one way to stop it. You need a larger entity that has more trust to come in and take over. In the TradFi world, that is a central bank with a printing press or a government with taxing authorities and armies to come in and basically say, now we're in charge, everybody calm down.
Okay, and so that was Mr. Jim Bianco, who was talking to the Crypto Daily Briefing, and from earlier today. Make sure that you watch it live every day at 12 p.m. Eastern. But yeah, very relevant, obviously. And Darius, I know you have some thoughts on that as well, regarding just the not this specific incidents right now with crypto, but kind of how it relates to and previous incidents of this happening in TradFi or traditional markets and traditional financial institutions. Do you want to elaborate?
Absolutely. Yeah. Thank you, Weston, man. I appreciate you. So every morning we put out a video called our Macro Minute, where we're just sort of going through kind of what's most topical through the lens of, kind of the most relevant economic data that's released across the globe for the last 24 hours. And then we go through sort of, kind of the different signals that we are highlighted. They're jumping off the screen from my perspective of my Longboard dashboard. But every once in a while, I'll get on a roll and start ranting about something that's very topical in markets. And I think my rant this morning was actually very relevant to the news that's breaking the tape right now, which is this CZ move to back out of this FTX, of this deal, not understanding the full kind of area of the full breadth of exposure with respect to Alameda. And what we were talking about was, there's so many parallels to 2006 and 2007, ahead of the global financial crisis of 2008 and 2009, in today's crypto ecosystem, that were sort of very, very highly correlated, or they kind of rhyme with what we saw back then. I mean, we saw sort of the trouble with Bear Stearns and it having to get acquired. I want to say I'm blanking on this, but I want to say JP Morgan acquired Bear Stearns, and then we had the trouble with Countrywide and it having to get acquired by Bank of America, and ultimately, those firms, JP Morgan and Bank of America, are still to this day dealing with the poor judgment associated with acquiring that credit risk too soon. And the reason I say the words too soon, it's very important because in 2006 and 2007, we were starting to figure out that there were cracks brewing in the system, particularly in the housing market, and how that may start to ripple across the broader economy. Certain investors really saw that coming and really had a great view on that. They're not certain, but a small number of investors, but most investors sort of, thought things would be ring fenced, if you will. Even our chairman, Bernanke, the former Fed chair, in fact said, I believe he used the exact word ring fence when he thought about some of these issues. But the reality was they were too soon. They bought the dip too soon in these particular assets, these troubled assets, not fully understanding the counterparty risk associated with it, in the sense that you could see some real bank runs, and not really understanding the credit risk associated with the broader business cycle. We are nowhere near recession right now. If you look at some of the different drivers of consumer spending of the broader economy, whether it be private sector labor income, as compounding at 6.6% on a 3-month annualized rate of change basis, as most recently as October. You got BEA data confirming that. If you look at the employee compensation, compounding at 6.5% on a 3-month annualized basis, both of those numbers are 50% of their pre-COVID trends in terms of the growth rate of the income consumers are receiving from the labor market. So we're still very far away from a below trend and even recessionary-like state in the economy. And so the reality is, if you're trying to allocate capital to what you perceive to be distressed entities at this particular phase of the game, you have no idea the full range of distress that could come upon those entities in an actual recession. Again, this is an economy that is still growing, technically speaking, above trend when you look at it on a nominal and real GDP basis. That won't last if you look forward 3 to 4 quarters. But again, for now, it's too soon. And I think CZ's doing the smart move, which is what we were talking about earlier in the macro minute. He's making the smart decision by sort of backing away and trying to fully assess, all the range of the probable outcomes associated here, because there's no way he understands that without a recession on the table.
Yeah, very good point. And so, Darius, I want to break down CPI. That's that we're on the eve of.
Can we
later
before we move on to CPI? Can we throw up Brian?
Go ahead.
Let's throw up those charts of net liquidity to kind of talk about what's happening in the crypto ecosystem through the lens of broader global macro. So, Brian, if you throw up that first chart, net liquidity, where we show, a net liquidity versus the S&P 500 versus Bitcoin and versus Ethereum, and the title of the slide reads, and it's very appropriate. Bitcoin is leading net liquidity lower, just like it led net liquidity lower in the fourth quarter of 2021 when we sold all of our crypto exposure, and it just like it led to the upside in 4Q20. In fact, in October of 2020 is the first time I ever bought Bitcoin. So, Bitcoin as an asset class has been leading these violent swings in net liquidity, and this is something we've been talking about on the program all year, which is things that are further away from the center of the financial system. I would consider, the treasuries in the center of the financial system. You broaden out to U.S. investment grade debt, U.S. investment grade corporate equities. The further you get across from the center of the financial system, the further you go out on the risk spectrum, the more imp swings and shifts in net liquidity tend to have these massive moves. And so what's very clear about this chart is that, hey, look, Bitcoin is trading well below what its fair value estimate would be currently in net liquidity. But then when you go back and look at these other historical intervals, particularly fourth quarter of last year on to the downside, fourth quarter of 2020 to the upside, you can see that Bitcoin has a penchant for front running these net liquidity fundamentals, and that makes a lot of sense in the context of it doesn't take a lot of flow at the further out on the risk spectrum to get price action to move in a material manner. And I think that's exactly what's happening in crypto on top of what's happening in terms of this FTX Alameda Binance issue. And the second thing I'd say on net liquidity would be the second chart, Brian, if you throw up that the other chart, drivers of net liquidity. So everyone's got their own way of thinking about net liquidity. I think ours has become, one of the more popular ones across global Wall Street, and we're very grateful for that over the past couple of 18 months or whatever. In our model takes the Fed's the assets on the Fed's balance sheet, and then we subtract the balances from the Treasury General account, and we subtract the balances from the reverse repo facility account, and we're left with the net liquidity function in terms of, what our estimate is sort of the total amount of capital, the base layer of capital that allows hedge funds, et cetera, to lever up and allocate to risk, or vice versa, to delever. And so some of these metrics we know, if you look at the blue line in this net liquidity chart, that's the Fed's balance sheet, the total assets on the Fed's balance sheet. We know that's going to at least target it to go down at about 95 billion a month over the next, it could be indefinite, but certainly over the next few months here in Q4. But the thing that's most damaging to something like Bitcoin and most damaging and really hampering investors' ability to take risk, to lever up and buy the dip en masse and really send this thing back to the moon is the dynamics we're seeing associated with the Treasury General account. We got the Q4 quarterly refunding announcement out of the Treasury last Wednesday ahead of the, or Monday and Wednesday ahead of the FOMC meeting. And the most important information that we extracted from that report and from that press conference are twofold. One, there's going to be no Treasury buyback at least until Q1, Q2 of next year, at least until February, March of next year. But secondarily, and more importantly, I would argue, is that the red line in this chart, one of these drivers of net liquidity, is going to go from what had been at the time 550 billion to 700 billion by year end. Now it's at 525 billion. So it's got to grow the Treasury General account balance by 175 billion by year end. That's a big issue in the context of that's an additional headwind from a net liquidity perspective, because again, increases in this balance drain reserves from the banking sector, from the broader system. And so I think what we're seeing on the tape as it relates to crypto is it feels like it's idiosyncratic, and it is partially idiosyncratic. But again, these things don't happen in the vacuum. Net liquidity, the net liquidity function is as bad as I've seen it in my career, at least heading over the next couple of months. And so it's going to be very difficult for people to lever up and buy the dip in Bitcoin and other assets, quite frankly.
It's like we pre-scripted this. I love it.
Well, this is my day job, man. I do this all day.
What, pre-scripting things with me? No, it's not. So here's what I'll say to all of that. I love your approach, especially with regards to analyzing Bitcoin price action, not as an idiosyncratic thing, but looking at kind of a bigger picture thing, looking at net liquidity, looking at the TJ, the Treasury General account, and these other factors which very much certainly impact price action directly or indirectly. Let me just actually throw up a series of charts of my own, Brian. If you just pull up these, I just have just four charts. This is, if you're still wondering why NASDAQ had a down day yesterday and then today. So this is just basically a simple chart. This is Bitcoin futures and this is NASDAQ futures in the last 2 days. Okay, so my point with this though is that TradFi people, you need to watch crypto as much as crypto people need to watch TradFi macro markets, right?
1,000%.
Yeah, because you always hear of you just go to chart 2, Brian. Over the longer term, right? The chart of Bitcoin futures and NASDAQ futures, right there. Most of the time, Bitcoin is led by equities, and you hear about this correlation with the NASDAQ and all that. But it's not always the case that Bitcoin is led by the NASDAQ or the U.S. indices. Notice the enormous off the chart record high BTC futures volumes that traded yesterday on that chart. That is a day that Bitcoin was driving the NASDAQ. And so you can't, a day like yesterday, you can't necessarily look at the U.S. Treasury, yield price action to determine what's happening intraday with the Nasdaq. You'd have to be paying attention to what's happening in the cryptos here. Chart 3, going back to the last 2 days. Then what else might be moving? Possibly both BTC and equities, i.e., risk assets, or at least moving in line with them. This is one of many. I'm pulling up the currency markets, notably the Chinese yuan, which, like any cross-asset comparison, this is not like a always and forever factor for risk price action drivers, and nor is it always going to be static to the same degree of relevance all the time. Drivers are always flexibly interchangeable with relevance, but notice that this is also happening in the background. Because there's a lot of developments happening out of China, and we'll get to China PPI in a minute too, Darius. Just take a look at that chart, and then the last chart. In terms of relevance and kind of dipping in and out of relevance, dollar yuan has been or if not the major risk asset downside driver as of late. In my view, and according to these charts, really since August, as you can see here, right? And now again, it's not always the case. As you can see, at the beginning of the year, it certainly didn't have any sort of relevance, and then it did, from March, and then it didn't, and now currently does. And if you look at it on an intraday basis, tick for tick basis, or a longer term chart, these are all factors that have nothing to do with the idiosyncrasies of FTX and Binance. And we need to keep that all of that in mind, because Bitcoin is probably the most global of asset classes maybe ever. And so it's not just based on two people. I think that kind of goes against their mantra.
Well, let me. I actually go ahead. Oh, sorry. I tweeted this
No,
morning.
go ahead.
My first thing I tweeted this morning, I said, this drama is a great teaching moment, and not just for investors in crypto. I think we kind of experience TradFi people kind of come off sometimes as talking down to what tends to be a younger crypto investor, and I certainly don't intend to do that. What we're really trying to do is help educate the audience. And hey, look, I got 14 years of grinding my butt off every day in a chair and learning a bunch of stuff, and I want to explain. I want to help my broader audience understand all the stuff that I've learned throughout my career. And this is I think there are three important lessons that investors should be learning, observing, and learning from this experience with FTX and Binance. And the reality is, number one, this concept of decentralization in the crypto market is an illusion. And I don't mean the protocol at the protocol level. I mean at the level that matters most to your damn wallet, which is the price of the dang freaking currency. The protocols might be decentralized as all hell, but guess what? We're all dealing with the whims and actions in our portfolios, or some portfolios, based on two guys' interactions who've been spatting and feuding with each other all year. So you to riddle me this, you don't see this kind of price action and behavior in the broader U.S. equity market, and certainly not in the fixed income markets in terms of centralization and having an impact like that. So again, I want investors to be aware where it matters most is your damn wallet and your portfolio. The crypto market is more decentralized than even most traditional TradFi markets. Number two, I've said this how many times on this program? I've said it with you, I've said it with Maggie, I've said it with Andreas, I've said it with Ash, I've said it every single time I've been on this show this year, or some version of this, which is when the macro fundamentals are bad, and we look at macro fundamentals through three specific lenses: where are we in the growth cycle, where are we in the inflation cycle, and how are those two things what are those two things telling us about where we're headed in the net liquidity cycle, which I would argue is sacrosanct to all those things. When macro is bad, micro doesn't matter. Like, micro might matter and make the macro worse, like it is today over the last 24 to 48 hours in the crypto market. But it's this stuff does not happen in a vacuum. If we were in the same bullish Goldilocks reflation type state that we were in from 2020 to 2021, when we had this massive bull run in crypto, where a lot of folks were making money hand over fist, not really understanding the risks they were taking, then you can make your stories up about micro and go far into the future with your projects and protocols, et cetera, et cetera. But when the macro is bad, it's all about net liquidity, it's all about the dollar, it's all about the Fed, it's all about all the stuff that crypto people pride themselves in not having to deal with, but unfortunately are being forced to. And then lastly, I get a lot of pushback on this, but until it stops being true, I'm going to keep saying it, which is US dollar net liquidity trumps all, particularly in these sort of bear markets, as long as the US dollar remains the reserve currency. Now, we can argue till the cows come home about whether or not the US dollar should be the US reserve currency, or we can pontificate whether or not, or when the US dollar is no longer going to be the reserve currency. I happen to have a variant perception on that. I think we're probably never going to lose that status, because we have a lot of guns and a lot of tanks and a lot of nuclear warheads that are designed to make sure that we don't lose our exorbitant privilege. But that's a different view. If you think some kids with some funky hair are going to sit at a computer all day and usurp the U.S. military, I just think that's a misguided view. Anyway, sorry.
I totally agree. Especially about the kids with the funky hair part. But let me ask you, because we are kind of running out of time, and I want to just quickly touch on.
Ask as many questions at this point as we need to, because I think this is a very important day to help investors manage risk.
Certainly so. I do want to address, first of all, we did come off midterm elections. Now, just keep in mind the midterm elections that took place yesterday. The votes are still being tallied up, so we don't have any final as of yet. Looks like the House is going to go red to the Republicans. However, the Senate looks like it's kind of coming to down to a runoff, and it's a dead heat, and that could potentially last for some time. This is very extremely familiar to November of 2020. But what do you make anything of the and then so basically the point there is that the Democrats, if they lose either chamber, right, of Congress, Republicans will be able to kind of block President Biden and his sort of agenda, if you will, and his his proposal. Do you see anything, Darius, from maybe like a sector allocation basis or a potential broader asset allocation basis, given this like not red wave blowout and or sort of near term uncertainty still that's going to be prolonged for a little bit?
Yeah, great questions, man. So I'll answer that two
Feeling,
ways.
whatever it may be.
Yeah, great question. So I answer that two ways. So there's the qualitative aspect of this discussion, then there's the quantitative aspect. I think the qualitative aspect's a little bit loose, so I'll start with the quantitative. We've backtested midterm elections, and by the way, I've been backtesting things for many years and building models for many years. There's few things that have as high as a hit rate as midterm elections as anything I've ever seen. I mean, with data going all the way back to 1946, I think there's been 19 midterm elections since then, and not inclusive of this most recent one. There is a 98% chance you're making money 3 months later, like a 95 or 89% chance 3 months later, 95% chance 6 months later, and then like an 89% chance 12 months later. It's one of the highest hit rates. I mean, most things, if you build a model in terms of trying to generate trading signals, are somewhere between 40% and 60%. I mean,
can you define what hit rate means? What do you mean by hit rate?
The stock market is up from the date of the midterm election, and it's like the median returns are actually quite robust. Like it's as bullish as anything as I've seen. It's as bullish to the stock market as QE is. Now the problem is when you actually look at those back tests from a conditional standpoint, i.e., which are the midterm elections where, I don't know, Fed hiking interest rates or in the middle of a bear market, the back test goes to poop. It doesn't. It's not a signal. And so you have to sort of weigh the broader sort of the base scenario, the base case data set with the realization that, hey, we're still in a bear market. Fed is still tightening liquidity, and that back test from a conditional probability perspective is actually quite moot. It really doesn't mean anything for the stock market. So I think we're learning that, and I think this sort of lack of red wave, this lack of massive move to the Republican side is sort of taking some of that gusto and that hopium associated with the post-midterm election, seasonality rally out of the system. And it was always going to be an uphill battle in the context of all the net liquidity dynamics that we were highlighting earlier. But now that uphill battle just got a lot worse because, again, I think the worst, from a qualitative standpoint, the worst possible dynamic is murky, right? If you get a red wave, now Biden has to bend the knee to some aspects of the Republican agenda. You might have seen some positive stuff on taxes, might have seen some positive stuff on energy production, et cetera. Some things might have came out of that. But if it's murky, then they're just going to be a lot more gridlock. And everyone says gridlock is fine, but gridlock's not fine when you're marching down a path to recession and inflation is still at 6, 7, 8%. No, by the way, that's probably something we should touch on too ahead of the Q&A.
Yep, indeed. Let me just remind people.
Yeah, do we want to be gridlocked with low growth and high inflation? No, you want policies to fix it.
Yeah, let me just remind everyone that in the depths of the financial crisis in 2008 in October, there was a bill for TARP that was sent to Congress that they voted down in the middle of markets melting down. And then they further melted down and they ran back and they passed that bill eventually. So, just if you were going to do that anyway, why not just like save hundreds of billions of dollars of, if not more than that, of asset value shedding, right?
So you're applying the wrong framework to evaluating politicians. Politicians don't do the right thing. They do whatever gets them votes. And so at the time, it didn't get them votes until they realized that this is actually bad for the market. And they said, no, wait, we need to get on board.
It's very important to distinguish between, because that's a narrative that's overused that like divided Congress is good for, it's positive for risk assets. In what context? If you're talking about like like when things are fine economically, then that may or may not be true. But like as Darius is saying, if you're looking at a Fed hiking into a recession, that's a very different dynamic of a divided Congress, because fiscal policy is what's going to really be needed in order to support that. And a deadlock Congress is not going to really help that. Let me ask you about the CPI that we're on the cusp of, Darius, because you're the man for that. I will note that China CPI reading came out earlier today in Asia, or yesterday in Asia. with a deflation for the first time in 2 years, in negative reading. So what do you make of that reading as it relates to maybe China itself and this kind of consensus narrative of like a reopen in the first half of 23? And can we extrapolate anything from the negative China PPI reading as it relates to developed economies, potentially like, near term, if not tomorrow's CPI reading?
Absolutely not. No, no. China's inflation has been divergent from U.S. and developed market inflation for about 18 months now. So they've been on their own cycle, partially because of zero COVID, partially because they're, in our opinion, at least according to our models, are very clearly stuck in what is the most obvious classic liquidity trap that we've probably seen since Japan in the 1990s. I mean, if you sort of look at all the things that would suggest an economy is in a liquidity trap, which is inability to grow above trend, or the underlying mean of growth is lower, the underlying mean of inflation is lower, declining working age population, decline, or permanent asset impairment from prior bubble peaks, all these different things, down declining real estate prices, like they basically like check in terms of liquidity, in terms of classic liquidity trap. So that's our main structural thesis on China. So it's not appropriate to extrapolate some of those dynamics to the U.S. economy that is quote unquote booming, at least according to our analysis, from a coincident to lagging indicator perspective. We are not experiencing those kinds of dynamics. Just a few charts before we turn it over to a few questions. I know we're running late on time here. We'll go quickly here. So Brian, throw up that core CPI chart just to get a little preview of the flare of how investors should be contextualizing the data into tomorrow's prints and future inflation prints. What we show here in core CPI are the 3-month annualized rates of change for the most recent print in the blue bar, the prior month in the gray bar, and then the 2015, 2019, the pre-COVID trend in the light blue bars. And we're showing this on a relative basis to the Fed funds rate. Where is inflation relative to the Fed funds rate? Because again, we know that historically speaking, in order for these inflationary episodes to sort of quote unquote get defeated by policymakers, we've historically had to see realized Fed funds over realized inflation. And so I don't think this Federal Reserve, with the influences of Lyle Brainerd and Chuck Evans and Neil Kashkari, who's a dove in Hawk's clothing right now, I don't think their influence as we go further towards in this business cycle towards a recession are going to allow Chair Powell to be as hawkish as he was last week or last Wednesday. And so it's our belief that the 3-month annualized rates of change in these indicators is the real juice, is where the action is. You can't wait for the year-over-year indicators to get to appropriate levels because the Fed is likely to have pivoted before that. And so when you look at these statistics, I think that I'd call out the statistic on the right of this chart, core CPI, services CPI less rent of shelter. That number is starting to come down, but it's still at 6.7% on a 3-month annualized basis, which is, by the way, what Powell told us to look at the data after we, I think, told him, because allegedly he watches Twitter through a private account. So I'm guessing it's one of the many things that we're providing thought leadership on. But anyway, so core services inflation less rent of shelter, excluding this whole nonsensical debate about owner's equivalent rent, is still at 6.7%. That number is way out of line with anything that is consistent with 2% inflation over the long run mean. And if you throw up the second chart, Brian, where we show underlying inflation, some of these more sort of super core metrics, whether you think about trim mean CPI, median CPI, sticky CPI, et cetera, those measures at trim mean and median CPI, sticky CPI at 7 to 8.5% on a month-over-month annualized rate of change basis are telling you that the inflation problem from a core perspective here in the United States is getting worse. Now, we published a 160-page slide deck yesterday that explains why all these problems are getting worse and how they're likely to continue, at least over the medium term. And so we would expect an upside surprise on the core aspect of the discussion in next month's print. And we think the balance of risks to the to core inflation is actually skewed to the upside. At least over the next 1 to 2 quarters, as a function of, again, all that research we pumped out. So, I just wanted to kind of hit on those things before we turn it over to some questions, because I think that might influence the queue.
Yeah, we're actually running over as it is because there's so much to pack in today. I just wanted to be clear. So consensus right now, I believe on core is at 6.5%, and then headline is at 7.9%, which is a decline from expectations. What's your so you're saying that the core inflation expectations are too low. What about your headline expectations relative to consensus?
It's who cares? Until energy
Doesn't
starts
matter.
to one, it's not where the action is. It's the reason
Right.
we're focusing on core because the Fed is
Right.
focusing on core. Our
Right.
entire
Exactly.
process is
Core
designed.
specifically core services.
Well, it's
Yeah.
designed to front run the Fed because they're
Right.
primarily the entity that most responsible for big fluctuations in net liquidity. I mean, we make changes as investors in terms of reverse repo facility, and obviously the Treasury General Account, the Treasury makes a lot of has a decent amount of influence as well. But obviously, clearly, the Fed and its signaling and interest rates, et cetera, kind of has its the biggest thumbprint on that model. So that's why we're focusing on these things because again, we're trying to put ourselves in a position to be informed by the data to make appropriate changes in our portfolio that will sort of be rewarded by changes that the Fed and other agencies subsequently make.
Indeed. So that's a perfect way to kind of sum things up. Look, Darius, I wish we had time for questions. But
We got to get a couple
we
in. Come on.
we're going over. Yeah. You actually did kind of answer a lot of them as they were kind of coming in. So I don't know if you have this like telepathy or something. But in terms of, I mean, a lot of it's just on Bitcoin getting hammered, and so what kind of potential price action do you see going forward, and so on and so forth. I would say that personally, I would say that you would need to seriously look at I mean, it's very, very opaque, but you need to kind of figure out how much leverage there is. And you need to, the only way to do that, or the closest way to do that, or one way to do that, is to look at just listed derivatives because those are at least listed. But yeah,
Let's can
yeah,
I take a step back? So I would argue, I would take it a step further and say it's not just about the stock of leverage, because if you think about it, leverage is actually the good thing when it makes the market go up. It's the raising of margin, the margin calls associated with leverage, the price of attaining leverage, the cost of capital changing at the margin that forces investors to reduce leverage is the
right.
issue. So that's
Yeah,
that's what you should be focused on.
exactly. That's what I meant by leverage. I meant leverage as a whole, as an entity, if you will, and the behavior of leverage as with that very much includes deleveraging and the absence of, or the removing of, and how much was kind of there in the first place, and all again, a lot of this is very kind of black box too. Look, Darius, this has been a lot of information in a very short amount of time. Thank you for staying over. I just wanted to just give some takeaways here because, with regards of what's happening with like FTX and Binance and all that, headlines, developments, yeah, they're very important. And they can and will and have been certainly moving, risk assets for the last 2 days or so. But with that said, we do need to keep an eye on things like net liquidity, and the actions of not just the Fed, but the U.S. Treasury Department. We have to watch things like the TGA, the Treasury General Account, and with regards to the midterm elections, they've backtested to have a very high positive equity market response. But again, we need to be in the context of and aware of the broader macro backdrop that we are in. And gridlock is not necessarily this sort of automatic good for markets risk on sort of backdrop either, in and of itself. In other words, as Darius said, these things do not happen in a vacuum. Okay, when the macro is bad, the micro doesn't matter. In the same way, when the macro is bad or good or whatever it is, like one specific idiosyncratic event or something, as big as that may be, in the crypto universe or in the political universe of elections or whatever it is, that doesn't matter, because there is a much bigger force, an umbrella overhead, that will kind of determine, and make those other relatively smaller things sort of more irrelevant. I don't know if that's kind of a sum up, more or less, of what you're kind of shared with us today.
Yeah. Can I end with like a quick public service announcement? Because I think this is a fantastic
Please.
opportunity to help teach investors, how to better think about managing risk. And again, I don't say that with a condescending, air of someone who's nailed financial markets and has everything figured out. But we do, we think we have a lot of stuff figured out and we can be, valuable to a broad audience. And so, I actually had a conversation with one of our new subscribers last night about stop losses and, kind of how we
I
think
saw
about
that
stop
and I
losses.
loved it. Yeah.
Yeah, it's a real institutional framework about thinking about risk management. And so, I think stop losses can be valuable for sort of retail investors, particularly if you're not sitting at your desk for, 14, 15, 16 hours a day like I am. I don't, I'm aware of what the price action is, but if you have a day job and you don't, stop losses can be valuable in helping you manage risk. But here's why, we don't necessarily believe in stop losses in here. And we'll actually use a live example of a trade that went wrong for us today in terms of how we think about that. So we bought the dip in Bitcoin yesterday. We've been playing the year with the lead. We're actually up year to date, and so we have an opportunity to provide liquidity heading into for some of these instances in the market, and so we took advantage of that opportunity. We had a specific set of exit criteria associated with what would make us get out of the trade, not a stop loss. Hey, if it goes down 8 to 10%, let's just get out of the trade. The exit criteria was if we saw another major candle down, then that probably means that there's going to be more trouble. And obviously, we got that second major candle down, and then subsequently to that second major candle down, we obviously getting headlines that are hitting the tape and causing more accelerated selling to the downside. And so what we're thinking about stop losses is not this sort of single factor price momentum based approach. We have a litany of models at 42 Macro that help us manage risk, probable ranges, crowding, et cetera, et cetera. We won't go into all the tools, but what we're trying to do with those models is expand what a stop loss is, which is alert and then immediate execution of a trade, and expand the alert side of that situation and say, hey, we don't just want to be anchored to single factor price momentum. There could be other qualitative and quantitative aspects. The quantitative aspect was if we're going to do another major candle down, historically, that's been a leading indicator for accelerated declines in this asset class. And then qualitative, hey, look, we probably got 1 to 2 days at most to pick up some points here because, again, we think there's probably going to be an upside surprise in CPI Thursday. So our window of time to generate profits in this particular trade is actually quite compressed. If we don't generate the profits in this window of time, then we got to get out. And so it's not just understanding, hey, well, if the thing went down, I don't know, 8%, let's just get out. It's understanding the quantitative signals, marrying those with the qualitative signals, and using that to manage risk appropriately. Always have a set of exit criteria to get out of a trade before you put it on. And when those exit criteria are met, get out of the trade. You will save yourself a lot of money over the market cycles.
Such a key point. Before you put a trade on, know how you're going to exit it, or what.
Know why you're going to exit it,
and why you're going to exit it, and potentially how you're going to exit it. And all that. Stop loss for me, actually, personally, they help me because like for me, if I'm trading futures specifically, I don't want a margin call, so I don't care what I'm going to get a margin call because if the broker doesn't care why this price is moving against me, then I don't care either. And so therefore, but again, it's all within context too, right? Has to be volatility adjusted. And you just that stop loss thing that you did, I think it's on your Twitter. I suggest everyone take a look at it. For everyone who is very sort of kind of glued to using stop losses, and kind of maybe rethink using how I go about using stop losses.
It's not that, again, by the way, we're both using stop losses. It's just that we're beefing up the alert side of the discussion. Stop losses are price factors, alert, immediate execution. Our stop losses are, we could have an alert, quantitative alert from a variety of different models. And then we decide based on the near-term catalytic calendars like CPI tomorrow, whether we want to execute that alert signal now or we execute that in a few days. And our decision today was to alert it now, earlier this afternoon, before the news hit at 4 o'clock. So I'm glad we got out because that would have been a lot more painful.
Indeed. Look, Darius, you're not going forever, but we are running over here. So to everyone out there, thanks for watching the Real Vision Daily Briefing with Darius Dale and I will be back tomorrow with Michael Howell. And till then, I wish you well. Keep your eyes on the tape, and make sure that you take a look at Darius's Twitter for what we were talking about regarding stop losses and all that too. Okay.
Thank you, Weston. Thanks everyone for tuning in. We appreciate y'all.